Somewhere in America right now, there is a retirement account that lost half its value in less than 18 months, and the person who owns it did absolutely nothing wrong. They didn't take out a risky loan, they didn't gamble on stocks, they didn't make a single reckless decision with their money. They just went to work, paid their bills, and trusted that the financial system protecting their savings actually knew what it was doing. And then, almost overnight, that trust turned out to be one of the most expensive mistakes an entire generation of Americans ever made. Because behind the scenes, inside the most powerful banks in the world, a quiet decision had already been made years earlier to stop asking one simple question: what happens if home prices stop going up? Nobody wanted to answer that question because the answer was going to be expensive. And when that answer finally arrived, it didn't just take down a few banks. It erased over $8 trillion in household wealth, wiped out nearly 9 million American jobs, and shattered a belief that Wall Street had spent decades convincing ordinary people to trust completely. By the end of this video, you're going to understand exactly how that happened, who benefited from it, who paid for it, and why the warning signs were sitting in plain sight the entire time. Stay with me, because this story is not just about 2008. It's about how easily a system built on confidence can turn into a system built on denial. To understand how something this big could happen, you have to start with a belief so ordinary that almost nobody in America ever questioned it. Home prices always go up. Not sometimes, not usually, always. It wasn't treated like a market opinion. It was treated like a law of physics, something as reliable as gravity. Parents told their kids to buy a house because it could only gain value over time. Banks built entire lending models around that assumption. Wall Street built entire financial products around it. And for decades, the belief held up well enough that nobody had a strong enough reason to challenge it out loud. But beliefs that go unchallenged for too long tend to attract people who are more than willing to exploit them for profit. In the early 2000s, the Federal Reserve, trying to soften the shock of the dot-com crash and the aftermath of the September 11th attacks, pushed interest rates down to levels that made borrowing unusually cheap. Cheap borrowing on its own is not dangerous. What made it dangerous was what it collided with. Banks and mortgage lenders quickly realized they could make enormous amounts of money not by lending carefully, but by lending constantly. Every mortgage they issued could be bundled up almost immediately and sold off to investors, which meant the bank issuing the loan barely had to care whether the borrower could actually repay it. The risk wasn't staying on their books anymore. It was becoming somebody else's problem the moment the ink dried on the paperwork. This is where the story stops being about houses and starts being about human psychology. Because once the people making loans no longer had to live with the consequences of bad loans, the entire incentive structure of the mortgage industry flipped upside down. Loan officers were paid based on how many loans they closed, not on whether those loans were actually good. The more mortgages they pushed out the door, the more money they made, regardless of whether the borrower could realistically afford the monthly payment. So lending standards that used to matter, income verification, credit history, basic proof that a person could pay their bills, started quietly disappearing across the industry. Some loans required no proof of income at all. People inside the industry had a nickname for these: liar loans. Not because every borrower was lying, but because the system had simply stopped bothering to check. And here's where it gets uncomfortable, because this wasn't just reckless behavior from a few shady lenders at the bottom of the industry. It was happening at the very top, inside the most respected financial institutions on the planet. Investment banks took these bundles of mortgages, many of them increasingly low quality, and repackaged them into complex products called mortgage-backed securities and collateralized debt obligations. These products were sliced into different layers of risk. And here's the part that should genuinely unsettle you. Credit rating agencies, the organizations whose entire job is supposed to be warning investors about danger, gave enormous portions of these bundles top-tier safety ratings. The same rating you'd expect on the safest government bonds in the world was being handed out to products built from loans given to people who, in some cases, had no verified income whatsoever. Why would anyone do that? because the rating agencies were being paid directly by the very banks whose products they were rating. Take a second to actually sit with what that means. Imagine hiring your own referee and paying him directly for every single game he officiates in your favor. That conflict of interest didn't cause the crisis all by itself, but it quietly removed one of the last checkpoints that could have stopped the entire thing before it spiraled completely out of control. At this point, you might be thinking, surely someone in a position of power saw this coming. And the truth is, some people did. A small number of investors, analysts, and economists looked closely at the data and became convinced the housing market was built on sand. But raising the alarm inside a booming market is one of the loneliest positions a person can be in. Home prices were still climbing every quarter. Wall Street bonuses were enormous. Politicians on both sides of the aisle supported expanding homeownership. Warning that the system was fundamentally broken meant going against the mood of an entire country that was making money hand over fist and didn't want to hear otherwise. This is one of the most important psychological lessons buried inside this entire story. When everyone around you is profiting from an idea, being right too early can look, to almost everyone else, exactly like being wrong. By 2006, the cracks started forming. Quietly at first, home prices, which were supposed to only go up, began to slow, then flatten. Then in some markets, actually drop. For homeowners who had taken out adjustable rate mortgages with artificially low introductory rates, this was the exact moment their monthly payments began resetting sharply higher, right as the value of their homes was falling instead of rising. People who had planned to simply refinance their way out of trouble suddenly had no equity left to refinance with. Defaults began climbing month after month, and because so many of these mortgages had been bundled into securities, sold across the entire global financial system, the pain didn't stay contained to individual homeowners in individual neighborhoods. It started spreading through banks, hedge funds, pension funds, and insurance companies that had no direct connection to the housing market at all, except for the fact that they owned pieces of these mortgage-backed products sitting somewhere deep inside their portfolios. This is the part most people completely misunderstand about the crisis. It wasn't really a housing crisis at its core. Housing was just the trigger. The real danger underneath everything was leverage, the practice of borrowing heavily to amplify returns. Many of the largest financial institutions in the world were operating with extraordinarily thin capital cushions relative to the size of the bets they were making. Some investment banks were leveraged more than 30 to 1, meaning for every $1 of their own money, they had borrowed roughly 30% more. In good times, that kind of leverage multiplies profits beautifully. It makes everyone look like a genius. In bad times, it means a relatively small decline in asset values can wipe out a firm's entire capital base almost instantly, like pulling one card out of the bottom of a very tall house of cards. By 2007, financial institutions across the country began quietly acknowledging major losses tied to mortgage investments. Bear Stearns, one of the oldest and most respected investment banks on Wall Street, saw two of its hedge funds collapse under the weight of mortgage-related bets that had gone catastrophically wrong. Within months, the firm itself was standing on the edge of total failure and was sold off in a hastily arranged emergency deal, a warning sign that most everyday Americans didn't yet realize was pointing toward something far, far larger on the horizon. Then came September 2008, the month the crisis stopped being a slow-building concern for financial insiders and became a full-blown national panic. Lehman Brothers, a 158-year-old investment bank that had survived the Great Depression, 2 world wars, and countless recessions before this one, collapsed into bankruptcy. It remains, to this day, the largest bankruptcy filing in American history. The government, which had already stepped in to rescue other major institutions, chose not to save Lehman, and the shockwave that followed proved just how deeply interconnected the entire financial system had become. Credit markets, the invisible plumbing that allows ordinary businesses to borrow money for everyday operations like payroll, rent, and inventory, essentially froze solid. Companies that had absolutely nothing to do with mortgages suddenly couldn't access the short-term funding they relied on just to keep the lights on. Within days, the government found itself rescuing AIG, one of the largest insurance companies on the planet, because AIG had been selling a type of financial insurance called credit default swaps, essentially placing enormous bets that mortgage-backed securities wouldn't fail. When those bets went bad on a massive, almost unimaginable scale, the losses threatened to cascade through nearly every major bank that AIG had insured. The government stepped in with an enormous rescue package because officials genuinely feared that letting AIG collapse could take down much of the global financial system along with it, like knocking over the first domino in a chain that stretched across the entire world. This is the point in the story where the crisis stopped being an abstract financial event happening on Wall Street and became something that touched nearly every single American household directly. Stock markets fell sharply, week after week. Retirement accounts lost a significant portion of their value almost overnight, sometimes cutting decades of savings in half. Businesses, unable to access the credit they needed to operate, began laying off workers in massive numbers. Unemployment climbed toward 10% nationwide. Families who had done everything right, who had never taken out a risky mortgage, who had simply invested responsibly for their future, watched years of careful saving evaporate because of decisions made inside institutions they had never even heard of. And here's the psychological wound that outlasted the recession itself. The part that changed how an entire generation thinks about money. Millions of Americans learned, in the most painful way imaginable, that their financial security had never been as separate from Wall Street's behavior as they had always assumed. You didn't need to own a risky mortgage to be hurt by risky mortgages. You just needed a job, a retirement account, or a local business that depended on ordinary credit to function. That realization changed how millions of people think about trust, about financial institutions, and about their own sense of control over their future. And for a lot of people, that skepticism never fully went away. The government eventually intervened with the Troubled Asset Relief Program, an emergency measure allowing the Treasury to purchase distressed assets and inject capital directly into struggling banks in order to prevent a total collapse of the financial system. It was deeply unpopular with the public, who watched institutions that had taken excessive, reckless risks receive massive support, while ordinary families lost their homes and jobs with no comparable safety net waiting for them. That anger didn't just fade away quietly. It reshaped American politics for years afterward and fed into movements across the entire political spectrum that shared one common grievance, a growing belief that the system had been rigged to protect the powerful while ordinary people were left to absorb the consequences. So what actually caused the 2008 financial crisis? If you're looking for one single villain, one bad decision, one broken rule, you won't find it, because that's simply not how this crisis happened. It was the product of dozens of separate incentives, each one reasonable enough in isolation, stacking on top of each other until the entire structure became dangerously unstable. Cheap borrowing encouraged aggressive lending. Lending volume was rewarded over lending quality. Complex financial products obscured risk instead of managing it. Rating agencies were paid by the very firms they were supposed to be scrutinizing objectively. Leverage turned small losses into massive, system-wide ones. And an entire culture, from regulators to borrowers to bankers, operated on the shared assumption that home prices could not meaningfully fall at a national level. Every individual piece made a kind of narrow sense on its own. It was only when you stepped back and looked at the whole system together that the danger became completely obvious, and by then, it was already too late to stop it quietly. There's a lesson buried inside this entire pattern that goes far beyond 2008, and it's genuinely worth sitting with for a moment. Financial disasters rarely announce themselves as disasters while they're actually happening. They tend to look, from the inside, exactly like prosperity. Rising home values felt like real wealth. Easy credit felt like real opportunity. Complex financial products felt like real innovation. The warning signs were there the entire time, but they were dressed up as good news, because that's usually how bubbles work. They don't feel like danger until the exact moment they burst wide open. If there's one single thing worth carrying with you from this story, let it be this: the safest looking system is not always the most stable one. Real financial safety usually looks a little inconvenient. It looks like asking uncomfortable questions when everyone else around you is celebrating. It looks like being skeptical of returns that seem too smooth and too easy to be real. It looks like actually understanding what you own, instead of blindly trusting a label that simply says it's safe. The 2008 crisis didn't happen because people were incapable of seeing the risk sitting right in front of them. It happened because, for a while, almost nobody wanted to be the one person in the room who pointed it out. The recovery that followed wasn't quick, and it wasn't fair in the way most Americans expected it to be. Banks that had been rescued with taxpayer support began returning to profitability within a couple of years, in some cases posting record earnings again by the early 2010s. Executives at many of these institutions continued receiving substantial bonuses, even as the neighborhoods hardest hit by foreclosures took the better part of a decade to recover any meaningful home equity. Millions of families who lost their homes during the crisis didn't just lose a piece of property. They lost the primary way most American households build long-term wealth in the first place. For a lot of those families, the effects didn't stay contained to 2008 or 2009. They followed them for years, showing up later in delayed retirements, children who took on more student debt because there was less family wealth to help them avoid it, and a general sense of financial caution that shaped major life decisions for a decade or more afterward. In response to everything that had happened, Congress eventually passed the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010, a sweeping set of regulations designed to increase oversight of large financial institutions, limit certain kinds of risky trading, and create a new agency specifically focused on protecting consumers from predatory lending practices. It was one of the most significant financial reform efforts in American history, and it did meaningfully change how banks operate today, requiring larger capital cushions and more transparency around complex financial products. But it's worth being honest about something here too. Reform after a crisis tends to fix the specific failures that just happened. It doesn't always prevent the next kind of failure from forming in a completely different shape. The tools change, the regulations change, but the underlying human tendency to chase easy returns during good times and ignore uncomfortable warning signs rarely disappears completely. Think about how strange the entire chain of events actually was when you lay it all out from beginning to end. A policy meant to help the economy recover from one crisis quietly created the conditions for an even larger one. A financial industry built around managing risk ended up manufacturing it on an unprecedented scale, and a rating system designed to warn investors about danger instead became one of the mechanisms that hit it most effectively. None of these people necessarily woke up one morning intending to cause a global financial collapse. Most of them were simply following the incentives directly in front of them, one reasonable seeming decision at a time, until those decisions added up to something none of them had fully anticipated. That's exactly why understanding this story matters so much right now, because the same psychological traps that built the 2008 crisis are still very much alive today. Easy money still tempts people into decisions they don't fully understand. Confidence still gets mistaken for safety, and the crowd is still usually the loudest right before it turns out to be wrong. If this video helped you see the 2008 financial crisis in a completely different way, do yourself a favor and subscribe to this channel right now, because this is exactly the kind of story we dig into here: the hidden mechanics behind money, markets, and the financial decisions that quietly shape your entire future. Hit that subscribe button, turn on notifications so you don't miss what's coming next, and drop a comment letting me know what part of this story surprised you the most. There's a lot more history like this waiting to be uncovered, and I don't want you to miss it.